Welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. We're in the midst of a discussion about some things about portfolio construction, diversification, risk tolerance, risk capacity. A very important topic for investors, whether your portfolio is $100,000 or $100 million. These are very important topics about diversification. If you missed the first segment, head over to the web, www.dlblain.com, and you can pick up the archive there in about a week or so. We've got a new website. You can download the podcast. You can stream it right across the internet, whatever your preference. You can also either watch the video or just the audio. It's really a great website. Anyway, so we were talking about diversification and how having 10 stock funds is not diversification. In fact, having 10 stocks, unless they are all in very disparate industries, is also not diversification. We talked a little bit about how you've got to have different asset classes, things that move in a different direction. We then moved into talking about risk capacity versus risk tolerance. Risk tolerance is how you feel, sort of your threshold for pain. Risk capacity is how much risk you can afford to take from a financial perspective. And we finished up talking about human capital. And human capital, which is the ability of a person to earn income, is the largest asset that people have when they start out. And it's those people that take that human capital and develop it, albeit a lot of times there's some luck involved. There's also a lot of hard work, but they take that human capital and they develop it. I was telling a story a couple weeks ago about people investing in the 401ks, and the key to investing and harnessing that human capital and turning it into wealth is investing and saving a fair amount of money over a long period of time. That's the whole key. And that's how you harness your human capital. Even if you never found a company that goes public, if you take some of your human capital, you're trading it every day for pay, take some of that money, a good percentage of it, put it aside for a long time, and that's how you transition that human capital so that when you're older, your human capital is much diminished. You don't have the earning power that you used to have, you don't have the lifespan, but you've transitioned from that human capital now to financial capital. Now you have the financial capital. And in today's modern society, that's sort of that's the game, is to transition, is to take your human capital when you're young or middle-aged and transform it into financial capital so that when your human capital is diminished through age or health or something like that, you still have your financial capital. Okay, talk about diversification. Hopefully you all understand that having 10 stocks or 10 mutual funds is not diversification. And in fact, what is diversification? And I thought it would be useful to run some statistics. I ran some data back to 2008, 2009, somewhere to talk about diversification and see what some of the answers are. A lot of times we will diversify the stock portion of a portfolio with bonds. We will also use things like commodities, real estate, gold, things like that. And a lot of this has been called into question because of the crisis of 2008, 2009. People say, oh, well, diversification doesn't work. My portfolio still went down. So one of the things in the bond arena that I want to talk about is we use different types of bonds. U.S. government bonds, short bonds, long bonds. There's also foreign bonds. There's inflation-protected bonds, emerging market bonds, all sorts of different types of bonds. And they all provide some degree of diversification. But bonds generally in the portfolio, in our portfolios, for one large reason, and that's to cushion the decline of the markets. You can invest in bonds for income, and that is certainly a legitimate answer for that. But we think the better use of bonds is to cushion the decline of the markets, and you do collect some income as you go along. Now, bonds have been a tremendous total return vehicle the past couple of years, but they're not always going to return that much, but they certainly have a place for cushioning the decline of the markets. And that's what we're talking about here, is diversification. And so I ran the data back to 2008, and I looked at, when we talk about diversification, what we really want is when the market goes down, we want what we own to stay, at zero or go up in value. That if the market loses 2% on one day and your investment loses 1.5% that day, well, yes, you were diversified and you didn't lose as much, but that's generally not what people are looking for. They want something that when the market goes down, their money is sort of protected and helps cushion that decline. And so we ran the data back and we looked at every day that the U.S. stock market declined 1% or more. And I ran this back through March 20th of 2008. And the reason I did that, that was the first day that some of the data was available for some of these investments. And what I did was I looked at when the market goes down 1% or more, which bond asset classes go up. Simple as that. That's what we want to happen. If we're investing in risky assets such as the stock market and we want to diversify, we want something that we're investing in. If the market goes down, we want this other investment to go up or at least stay even. It's very eye-opening when you look at some of the data behind the correlations and diversification factors, that there are very few investments that actually go up when the market goes down. Well, we're coming up on the next break, so I'm going to make you tune back in after the next break to hear the answer, to figure out what goes up when the market goes down. So for All Things Money, I'm your host, David Blain, and we'll be right back after a few short messages.